Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're taking a closer look at Ontario's real estate market trends for 2025. The Canadian housing market, especially in Ontario, is currently navigating through a period of significant shifts, which present both challenges and opportunities for buyers and investors. In 2024, we observed a dynamic shift across Canada's housing market. Ontario, in particular, experienced a mix of stability and slight declines in property prices. For instance, in December 2024, the average home price in Ontario was $834,123, which marked a 2.3% decrease compared to the previous year. This indicates a broader trend of stabilization after several years of rapid price increases. Condominium prices saw a more pronounced drop, with the average selling price decreasing by 4.1% to $586,000 during the same period. Despite these price declines, sales activity remained resilient. There were 8,997 home sales in December 2024, which is an 8.1% increase from the previous year. Additionally, the market saw an increase in inventory, with active listings up by 24.7% to 43,779 units, indicating a buyer's market in some regions. Looking ahead, Ontario saw approximately 180,881 homes sold throughout 2024, marking a 3.1% increase from 2023, suggesting a market recovery was underway. For 2025, early indicators suggest a continued uptick in sales, with forecasts predicting an 8.6% increase in national home sales from 2024. This could translate to around 532,704 properties traded across Canada, with Ontario expected to maintain or slightly exceed its 2024 figures. In terms of price predictions, a 4.7% rise is projected nationally in 2025. Given Ontario's current market conditions, we might see similar trends, particularly in areas outside major urban centers like Toronto, where affordability could drive demand. The condominium market, especially in the Greater Toronto Area, is expected to continue experiencing price pressures due to an oversupply in new constructions. However, with the right timing and location, condos might still offer good investment opportunities. Several factors are influencing the market. Lower interest rates from late 2024 into 2025 are likely to stimulate buying interest, although they could also push up prices if demand spikes too quickly. Recent adjustments to mortgage rules, including longer amortization periods for first-time buyers, are expected to ease entry into the market, potentially boosting demand. For those looking to make a move in the Ontario housing market, the current scenario presents several advantages. With increased listings, buyers have more options, which could lead to better price negotiations. Additionally, while there might be slight increases, the market isn't expected to see dramatic jumps, offering a more predictable buying environment. As we progress through 2025, the interplay of supply, demand, and economic policies will continue to shape Ontario's housing landscape. If you're considering buying, this might be a strategic time to leverage lower prices and interest rates. However, it's crucial to remain vigilant about local market dynamics, as they can vary significantly from one city to another within Ontario. The latest news in the Canadian mortgage industry is that 5 of the country's big 6 banks have reduced their fixed mortgage rates. This development follows a significant drop in bond yields, which are down over 50 basis points from their January highs. Bond yields are a key factor in determining fixed mortgage rates, and this decrease has prompted banks like the Bank of Montreal, Canadian Imperial Bank of Commerce, Royal Bank of Canada, Toronto Dominion Bank, and National Bank of Canada to implement rate cuts ranging from 0.10% to 0.25% across various mortgage terms. It's not just the major banks making these adjustments. Numerous other mortgage providers have also been lowering their rates in response to the bond yield decline over the past 2 weeks. According to rate expert Dave LaRocque, the drop in bond yields is partly due to concerns about a potential trade war with the United States. However, LaRocque warns that such economic pressures could lead to rising rates if inflation becomes a persistent issue. He explains that while tariffs initially pushed bond yields down, they are inherently inflationary, which could eventually drive both bond yields and fixed mortgage rates higher if inflationary pressures broaden. Ron Butler from Butler Mortgage also shared his insights, indicating that the United States forecasts for only a single quarter-point cut at the year-end, or potentially no cut at all, could lead to conventional rates climbing by another 20 basis points. However, Butler expects the spring real estate market to be highly competitive, with banks eager to gain market share and retain renewals. He notes that lenders like Royal Bank of Canada and Canadian Imperial Bank of Commerce, which don't typically operate through broker channels, are particularly focused on maintaining their share. Additionally, the Bank of Canada's recent series of rate cuts has brought variable mortgage rates close to the level of fixed rates. This situation presents a dilemma for borrowers who must decide whether to opt for the potential savings of variable rates amidst the current market volatility. The Bank of Canada is currently under significant pressure to continue cutting interest rates, as the economic landscape remains uncertain due to ongoing trade tensions with the United States. Analysts are suggesting that broad-based U.S. tariffs could necessitate larger interest rate cuts to help Canada navigate through these economic challenges. Since June of last year, the bank has already made 6 consecutive cuts, bringing the overnight interest rate down from a peak of 5% to 3%. Despite recent signs of economic activity gaining momentum, the possibility of a pause in rate cuts seems unlikely, especially given the unpredictability of U.S. trade policies. Mackenzie investment strategist Dustin Reed believes the Bank of Canada might reduce rates to the lower end of its neutral range, around 2.25%, within the year. If tariffs increase significantly, the policy rate could potentially drop to 1.5% or lower. Desjardins Group's chief economist Jimmy Jean notes that recent tariff announcements by the U.S. have created a volatile environment. He predicts that the Bank of Canada might cut rates further into accommodative territory, possibly around 2%, if the tariff situation remains mild. However, if the tariffs prove to be more substantial and prolonged, there could be a greater likelihood of deeper cuts. The Bank of Canada has already implemented 2 back-to-back 50 basis point cuts at the end of 2024, followed by a more conventional quarter-point cut in January. Mortgage expert Penelope Graham anticipates at least 2 additional moderate cuts by summer, even if Canada avoids severe tariffs on exports. These cuts are expected to be influenced by economic data, including inflation rates and job growth. Canada's economic outlook for 2025 is clouded by uncertainties, particularly due to its close economic ties with the United States. The unpredictable nature of U.S. trade policies, especially under Trump, means Canada must remain vigilant. The country's growth trajectory will largely depend on how cross-border taxes are finalized, with the Bank of Canada's growth forecast potentially skewed to the downside. Penelope Graham also highlights concerns about the Canadian dollar's weakness and how it could affect economic growth. The loonie faces downward pressure from both tariff fears and the Bank of Canada's diverging course from the U.S. Federal Reserve. Additionally, Graham points out that a slowdown in immigration and low productivity levels could be significant themes for Canada this year, even without tariffs. Ultimately, the Bank of Canada's interest rate decisions will be driven by various factors, including inflation, unemployment, and consumer and business activity. According to the latest monetary policy report, the economy is projected to grow by an average of 1.8% this year and next. The bank will also need to consider the effects of past rate cuts, the housing market conditions, and the overall economic sentiment. For consumers, the Bank of Canada's policy decisions directly impact borrowing costs and affordability. Penelope Graham advises Canadians to be cautious when taking on debt, given the current market volatility. She emphasizes the need for borrowers to carefully consider their risk capacity and the type of debt they choose, such as fixed versus variable mortgage rates, in light of the ongoing economic uncertainties. Investors should also stay prepared for potential economic upheavals. While the Bank of Canada can't prevent economic shocks, it can help the economy adjust to high uncertainty or potential trade shocks. Jimmy Jean warns that a sustained 25% tariff could lead to a recession, though it might not be as severe as the one during the COVID-19 pandemic. The real concern lies in the structural changes tariffs could impose on businesses. The City of Orillia has successfully secured $4.5 million in funding through the Canada Mortgage and Housing Corporation's Housing Accelerator Fund, Round 2. This funding is aimed at fast-tracking housing initiatives and increasing the housing supply in the community. Mayor Don McIsaac expressed gratitude to the Government of Canada, emphasizing that access to safe and affordable housing is a key priority for both the Council and the community. He noted that this funding would enable significant progress in housing initiatives, ensuring Orillia remains a vibrant and inclusive place to live. The Honourable Nathaniel Erskine Smith, Minister of Housing, Infrastructure and Communities, stated that the government is committed to removing barriers and cutting red tape to facilitate housing development. Partnerships with communities like Orillia are crucial to achieving this goal. The funding will support the development of 100 additional affordable housing units over the next 3 years. Orillia's successful application included a housing action plan with 9 key initiatives, such as expanding mixed-use zoning, reducing parking requirements near transit, and implementing an e-permitting system to streamline approvals for rental developments. A critical requirement of the funding is for the city to pre-zone residential lots for up to 4 dwelling units. A public meeting regarding this proposed zoning bylaw amendment is scheduled for March 24, 2025 at the Council Chamber in Orillia City Centre. The City of Orillia also plans to launch a grant program in September 2025 aimed at supporting eligible nonprofit housing projects that are shovel-ready. Information sessions and application details will be available by July 2025. The Housing Accelerator Fund is a $400 million federal initiative designed to assist municipalities that were not selected during the first round of funding. The program aims to accelerate housing supply and address systemic challenges across Canada. The debate over whether it's too easy to become a mortgage agent in Ontario is once again a hot topic within the province's mortgage industry. This conversation revolves around whether the standards for becoming a licensed mortgage agent should be elevated. The role of a mortgage agent is crucial, as these professionals guide borrowers and prospective homebuyers through what is often the most significant financial transaction of their lives. The Financial Services Regulatory Authority of Ontario, known as FSRA, has been monitoring the standards within the industry. Last year, they introduced a new prerequisite for agents to complete an additional qualification if they wish to transact in private mortgages. Despite these measures, several industry leaders continue to call for a more rigorous and comprehensive training course to ensure only those serious about the profession enter the field. Kimberly Freeman, the founder and president of KMF Enterprises, argues that the current requirements to become a mortgage agent in Ontario are insufficient. She believes that the time and financial investment required to complete the relevant course do not provide a comprehensive understanding of the field. Freeman stated, "The solutions being provided, the amount of money that you're helping clients obtain, the compliance risk, and the lender programs aren't covered nearly enough." Freeman suggests that FSRA is on the right track with its licensing requirements, but advocates for a revamp of the mortgage agent licensing course. Her vision includes making the course more costly and intensive, with a deeper dive into lender programs and underwriting processes. This, she believes, would deter those who might view the profession as a quick way to earn money without understanding the responsibilities involved. The profession can indeed be lucrative, especially with new mortgage guidelines potentially expanding affordability for buyers. However, Freeman stresses the importance of ensuring that new agents are entering the field for the right reasons. She calls for a distinction in FSRA's regulations between mortgage investment corporations, MICs, and smaller private lenders, suggesting that new agents should be restricted from dealing with mom-and-pop lenders until they have more experience. Freeman also emphasizes the role of principal brokers in maintaining industry standards. She believes brokerages should have stringent hiring practices and maintain high standards when building their teams. That takes us to strengthening the onboarding and hiring process, Do you take on a part-time agent or make full-time mandatory? She questions. Freeman argues that hiring should not be rushed, and brokerages should focus on long-term excellence rather than immediate gains. Freeman acknowledges that changing the mindset within the industry is challenging but necessary. She suggests that principal brokers should overcome the fear of missing out on short-term business by focusing on hiring the right people who follow the system and possess the necessary skills. If we can do this together, prior to the mortgage course being changed, then I believe we will see some very positive results in strengthening the overall quality of our industry, she concludes. In a significant development for mortgage holders, the Royal Bank of Canada has introduced a new feature in its mobile application, allowing clients to renew their mortgages digitally. This innovation eliminates the need for a branch visit or a conversation with an advisor, addressing a common frustration for many bank customers. The feature is timely, as nearly 40% of Canada's mortgage loans are set to renew in 2024 and 2025, according to the Canada Mortgage and Housing Corporation. Janet Boyle, Senior Vice President of Home Equity Finance at RBC, emphasized that the bank is committed to reducing the stress associated with renewing or applying for a mortgage. She stated, "This marks the latest stage in our evolution to provide digital and mobile services that enhance security and transparency in the mortgage journey, while offering clients more choice in how they want to manage their mortgage." The mobile app feature allows eligible clients to secure the best available RBC rate, select a mortgage term, and sign renewal documents within minutes. For those needing extra assistance, the app provides the option to pause the process and consult an RBC advisor before completing the renewal. This approach aims to streamline the renewal process while still offering the option of personalized advice. The popularity of mobile banking has soared in Canada, with RBC reporting a 69% increase in active mobile users since before the pandemic. This new feature is not exclusive to RBC, as both TD Canada Trust and Scotiabank offer similar capabilities in their mobile applications. This trend reflects a broader shift in the banking industry towards enhancing customer experience through digital solutions. As digital solutions continue to evolve, they are reshaping the way financial services are delivered, offering more convenience and flexibility to clients. This move by RBC could set a precedent for how banks approach mortgage renewals in the future, potentially influencing industry standards and customer expectations. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time, and stay informed with the latest industry insights.